Welcome to Smoke and Mirrors, the podcast that cuts through the noise of the many policies and regulations that affect American agriculture. Each week, we pull back the curtain on the programs, policies, and perceptions shaping the agricultural community in rural America. If you've ever felt like something doesn't add up, you're not alone. I'm Jenny, and this is Smoke and Mirrors. Let's make sense of the maze we call farm policy. Welcome to Smoke and Mirrors, the podcast where we make sense of agricultural policy. I'm Jenny Ifft. I teach agricultural policy at Kansas State University. This week we're doing something special. I'm joining Shelby Varner, the host of Agriculture Today. Agriculture Today is a podcast and radio show that covers the latest research, issues, and topics in agriculture from K-State Extension. I'll be joined by my colleague, Dr. Brady Brewer, to discuss the farm management and financial implications of ad hoc payments. Ad hoc payments are an increasingly important part of the federal farm safety net. What's special about this episode is that we discuss the realities, the practical aspects of this policy from a farm management perspective. I think this perspective of how policies are experienced by managers, by farm operators, is a really important part of making sense of agricultural policy. So thanks for joining us and enjoy.
You're tuned in to Agriculture Today, and we start our show discussing ad hoc payments with K-State Flintshire Agricultural Policy Chair Jenny Ifft and K-State Associate Professor in Agricultural Economics Brady Brewer. Jenny, Brady, I appreciate you both taking the time to join us today.
Thanks for having us.
Yeah, thanks for having us.
While we're talking about ad hoc payments or one-time government payments, Brady, can you explain to us a little more about the details of what is an ad hoc payment?
Yeah, so the term ad hoc, if you look it up in a dictionary, means when necessary or needed. So I think first off, we probably want to just distinguish what makes an ad hoc payment versus what would maybe be our traditional Farm Bill program payment. So as the definition implies, when necessary or needed, these are payments that some form of government, I think here lately it's been more the executive branch of the government. So the president says, hey, there is a need out there to provide farmers or some sector of the economy with relief, and they have found the funds to do it. It is not from a recurring bill of any type. They have found the funds and then they have issued those funds. This is different from what we have traditionally known in agriculture from the Farm Bill, where, we re-up the Farm Bill on a regular basis, and those payments that farmers sign up for, they're set formulas that we know are going to trigger payments, whether it be price levels or county revenue levels. Those are what I would consider more the traditional Farm Bill program payments. The difference here is just how we can expect these payments to come. These ad hoc payments can be very irregular in terms of when they come, because it takes the political will of whoever's in power or a certain branch of government to kind of issue them. Okay. There are other types of payments out there, such as disaster relief, that may be more on an ad hoc basis. But here we're talking about, I think a really good example is the market facilitation payments we saw about 5 or 6 years ago that were to compensate farmers for the losses they saw due to some of the trade negotiations that were happening at that time.
Jenny, how important have you seen these past payments be for agriculture?
Well, they've been large since 2018, so we're going on 8 years right now. One way to look at importance is how big these ad hoc payments are relative to farm income for the state of Kansas. So that would be all income across crop and livestock operations. And since 2018, Brady already mentioned the market facilitation program payments from the first Trump administration. We also had COVID-related payments. We had the emergency relief program, which was a series of disaster payments. And then recently we had the ECAP, Emergency Commodity Assistance Program, and SDRP, Supplemental Disaster Relief Program. So we passed the acronym quiz, and we may have another one coming. The current administration has been pledging that there would be some type of tariff relief payment or trade relief payment for farmers. But to get back to farm income, we can look at how big these payments are relative to farm income in Kansas. And if you pull the numbers from 2018, ad hoc payments have been from 5 to 47% of net farm income. For 2025. They're forecast to be about a quarter of net farm income. So that's a pretty large share, and it does go up and down a lot. And part of the reason is these payments aren't always made in the year that the loss is incurred. You can compare this to 2015 to 2017, which, if you remember, those were pretty lean years. And in those years, government payments, so the Farm Bill payments, the ARC, agricultural risk coverage, and PLC, price loss coverage, those Farm Bill payments were about 15 to 25% of Kansas net farm income. So they were sizable. Net farm income was lower in those years. But, overall, you have seen these ad hoc payments make up a substantial share of farm income in recent years.
For ad hoc payments, do all operations get the same amount, or is it scaled?
So it really just depends on the program. So the ECAP payments, Emergency Commodity Assistance Program, that was about, $20 to $40 an acre, depending on the crop. But it was one rate for an acre of crops planted across the country. Some of the disaster programs are based on losses. So it's like a top up to crop insurance, or it can make a disaster payment for uninsured crops. So again, it really varies a lot depending on the program.
And a lot of times when we're thinking about money, we think about money as a positive thing. However, when we're thinking about ad hoc payment money, does it need to be viewed a little bit differently?
Yeah. So as I mentioned earlier, because the political will of these ad hoc payments can depend on who's in power, and sometimes they have to go find the money for it, the variability and timing of these payments can be a lot greater than what we see with Farm Bill payments, right? We typically know when Farm Bill payments are going to be paid out. Because there is a set formula behind those Farm Bill payments, while a farmer may not know their exact amount that they're going to get paid until after harvest, we can start estimating, we know the conditions of the crop, we know the price levels, we can predict out like a marketing year average for prices ahead of time, before harvest. So a farmer knows, okay, roughly at the end of the year or at this point in time, this is what I can expect to get paid based on current crop conditions. With these ad hoc payments, though, since there's really no set formula announced ahead of time, it does depend on the political will at the time as well. We have to be a lot more careful with how we manage them. So I'll give a couple examples. The second tranche of the market facilitation payment, it was announced on November 15th of 2019. This was announced, and they started paying mere days or weeks after it was announced. This didn't give the farmers a whole lot of time to plan, thinking about tax purposes, capital expenditures at the end of the year for tax purposes. It didn't give the farmers a whole lot of time to plan, okay? And now we're currently here in 2025 experiencing kind of the opposite, where the government has said, hey, we have seen President Trump and heard him say, hey, I want to compensate farmers for maybe some of the trade losses they're experiencing with some of the tariffs, but we haven't seen that come through. So in this case, we have the opposite, where we've kind of had some announcements, but nothing official has come down the pipeline. So it's being delayed. So those are really two examples that show the two kind of sides of ad hoc payments, coming quickly or being delayed due to government issues or political will. So when we think about that, farmers need to think a little bit more long-term with these ad hoc expenditures and be ready for if stuff is going to pay out, or in some cases, if it's not going to be paid out. So the management of this is a little bit different from when we are guaranteed or a more certain payment is going to happen.
And thinking of those different strategies, Brady, you mentioned long-term, and Jenny, what are some considerations if we're thinking long-term for producers that they should take into consideration?
All right. So long-term I guess if we could just pick one, we'd probably say think long-term. It's really easy, especially in sort of lean times or times of tight profit margins, to focus on short-term needs. But what we're encouraging producers to do is take a step back and think about positioning yourself for the next few years. So that's the most important thing. Next, cash flow planning. It's essential. So, looking at, are you going to have enough cash? What's your working capital situation? Not just right now, but over the next, next year, next 2 or 3 years. So that's one part of it. Think long term, consider cash flow planning. The third one is consider paying down debt. Now, that's not for everybody, but if you have sufficient cash for your short-term needs, you don't need that money that would be for a payment for an expense that's coming up. And also, if you have a lot high interest rates on your current debt, that's a situation where paying down debt could lead to some real savings and put the operation in a good position. Next, number 4, evaluate equipment purchases carefully. This can be a really attractive option when you get a one-time payment. Farms have to regularly update their equipment, and it can provide tax savings through accelerated depreciation. But we're encouraging people to look at what's the impact of your cost of production. So you're going to have high machinery costs. Look at your labor and operating costs. Also your long-term asset efficiency. And I do know with the Kansas Farm Management Association, they do see that farms that are more profitable have lower machinery costs per acre. So that is something that can have a real difference. So number 5, avoid letting this payment influence cash rent expectations. So there's some producers out there, they might have some annual negotiations with a landowner, and that landowner might have heard, hey, I heard you got this big payment, and that might become a part of negotiations. So, being able to communicate that, okay, here's my current income, here's what this payment was, it was a one-time payment, and the cash spread should be based on future expected income, not past payments. So managing those expectations there and perhaps going into those negotiations, with some understanding and ability to explain that. There's one thing I want to ask Brady, though. Brady, we talked that these payments might, come out. There might be an announcement, these tariff payments, there might be an announcement sometime this week or next week. How concerned should producers be about tax planning? Because, technically it could come out before the end of the year. It could come out on January 1st. That would make me a little bit nervous.
Yeah, and it would make me nervous too, Jenny. So I think that's what we're saying here is thinking a little bit more long term. So if I'm a producer here, we could have these payments be announced here over the next couple of weeks. We're currently recording this at the 1st of December in 2025. We only got a month left before, tax rolls. Most farmers are on a January 1 tax planning cycle. That means that you may have a large revenue intake here at the end of the year. So thinking about prepaying expenses to maybe shift costs from the future crop cycles to this tax year may be a certain scenario there. So that's why, I think to clarify what Jenny is saying in terms of thinking more long-term is thinking beyond just this particular tax year. And especially from the cash flow planning perspective and the capital expenditure planning. The example I give is let's take the farm that Jenny is saying. We could get a revenue inflow here in December of 2025 from these payments that could be announced. I think in general, the immediate strategy would be to say, let's maximize our profit this year. Let's see if we can do a capital expenditure that we could get accelerated depreciation on to reduce our taxable income in 2025. The problem with that is, let's say we get to 2026. Let's take everything we've said about ad hoc. It takes the political will. They're more variable. We continue to have a downturn 2026. Well, if the farm program payments aren't going to trigger, we now need working capital and sufficient liquidity into 2026 if more ad hoc payments don't show up. So I think that's a prime example of when we say think long term, is that it may be worthwhile to take a tax hit this year. And obviously, every farmer, we would advise you to work with your accountant. They know your operation best. But it's worth asking the question, what happens if we don't get the ad hoc payments next year? Do I have enough cash or short-term working capital to survive? And if the answer is no, that's where we may want to think about not going to, get that accelerated depreciation this year, taking a slight tax hit, but saving that ad hoc payment this year for next year when it may not come. And, the name of the game here in these lower commodity price environments with this ad hoc era is survive in advance, right? So, thinking about what will it take for me to stay in operation next year if an ad hoc payment doesn't come around. I typically, this is a concept that I call burn rate, right? How much cash do we have on hand to burn if revenues stay low? How many planting seasons can I survive if that were to be the case? And I think that's a question a lot of producers need to be asking.
Are there any other considerations that they should be taking into account?
Well, one thing is we've been focused on ad hoc payments. There is a substantial payment from Farm Bill programs, ARC and PLC, Agricultural Risk Coverage, Price Loss Coverage, that I mentioned earlier. And these payments made a big difference in that sort of 2015, 2017 period. And they still paid out a little bit after that. The payment rates for those were increased in the One Big Beautiful Bill Act. So given current forecasts, it's not guaranteed, given current forecasts, producers could expect substantial payments for the 2025 crop year in 2026, October 2026. So there is a chance that, maybe these higher support levels through Farm Bill programs will lessen the need for ad hoc payments. However, those payments were delayed the 2024 payments were delayed this year because of the government shutdown. So, and then this is really a sort of a question of what are your personal preferences? How much risk you're comfortable with? But, even though those Farm Bill payments are expected, things can go wrong with the government or anything else for that matter.
As we've discussed these 5 key considerations for what someone might want to do or how they could use their one-time government payment, what would you encourage people to take a deep dive look in with their accountant or even by themselves?
So I'll go first, and I think there's several things. So Jenny and I may answer differently here, Shelby. Mine is going to be working capital. I mentioned the burn rate, figuring out, hey, if current revenue levels stay the same, and these payments don't materialize, or as Jenny just said, are delayed in 2026, how long can I survive, right? So plan out capital expenditures you may need, plan out operating expenses, calculate your burn rate, how many planting seasons can you go, and then figure out what these one-time ad hoc payments do to that. Is this something we need to save and hold back to extend that burn rate? Or if we're in a good working capital position, that's where we can go and evaluate maybe capital expenditure purposes, think about tax savings, and think about our immediate needs if the long term is already secure.
If people want to find more information about this or read on this topic, what's your recommendation?
So go to agmanager.info. We just put out a brief, top 5 considerations for managing large one-time government payments. It lays out what we've talked about here. Also reach out to any of us. This isn't a topic that people have been talking a lot about, but we have had 8 years of substantial but volatile ad hoc payments. So we think it's worth consideration in the current farm economy. The Department of Agricultural Economics is also doing a series of ag profitability conferences across the state of Kansas. There's 9 of these. They're in person. We're going to cover a variety of topics. So cash flow planning strategies. We'll look at the crop sector outlook. We'll look into trade. We'll look into managing farm programs. So, trying to get, I think, what was the term, Brady, what was the term you used? Survive in
advance.
Survive in advance. So it's not just about survival, it's also about advancement. So giving producers strategies that they can use.
Jenny, Brady, I appreciate you both taking the time to join us today.
All right. Thank you.
Thank you for having us.
That was K-State Flinchbaugh Agricultural Policy Chair Jenny Ifft and K-State Associate Professor in Agricultural Economics Brady Brewer. If you'd like to read more on this topic or check out the Ag Profitability Conferences, as Jenny mentioned, you can go to agmanager.info.
Thanks for joining us on this episode of Smoke and Mirrors. If today made you think or see things a little differently, share it with someone who appreciates cutting through the noise. Don't forget to subscribe, rate, and leave a review wherever you get your podcasts. Thanks for spending part of the day with us. Until next time, keep asking what matters.